Almost every retirement saving article that you read throws out the term pre-tax and post-tax out there without ever explaining the importance or what these terms even mean. Hi, Vincent Chan here, and in today's video, we're talking about pre-tax and post-tax, what they mean and why they matter to you. If that sounds good, make sure you smash the subscribe button and ring the notification bell to always get the latest and greatest from The Simple Dollar. And remember, you can find this content and loads more by visiting thesimpledollar.com. Most people have a couple of options when it comes to saving for retirement. For example, you can simply save money in a savings account. However, there's no real benefit there when it comes to your taxes. Certain people with a retirement plan tied to their work can actually access accounts such as the 401k or the 403b or other equivalent accounts. Outside of that, people also have access to this thing called the traditional IRA. And all of these plans have some things in common. First of all, if you put some money into these plans, then you don't have to pay income taxes on that amount of money for that year. For example, let's say you make $50,000 a year and you want to contribute $5,000 towards your 401k plan. What that means is instead of paying taxes on your income of $50,000, you'd only pay income taxes on $45,000. This is why when it comes to these plans, it's called pre-tax money, because the amount of money is actually deducted from your pay before your taxes are calculated. Let's say you make $50,000 and you don't contribute anything to these pre-tax accounts. That means the federal income tax you'd pay is $5,719 that year. If you don't think that's a big deal, let's actually put some numbers around this. Let's say you're a single individual who makes $50,000 a year, and if you don't contribute anything to your 401k plan, that means your federal income tax for that year is $5,719. However, if you contributed that $5,000 amount towards your 401k plan, your federal income taxes for that year is now $4,744. That's right, every contribution you make towards a pre-tax retirement account actually cuts down the amount of taxes that you end up paying. Because some of that money is going towards your 401k, that means you pay less in taxes, but that also means your take-home pay will be a bit lower. That's pretty much the core idea behind pre-tax contributions. You don't have to pay taxes on that money right now, but when you start withdrawing that money from these accounts during your retirement age, you're gonna start paying taxes then. So what about post-tax contributions? And that's pretty much where Roth accounts come in. So your Roth accounts are those that take in post-tax contributions. For example, Roth IRAs or Roth 401ks, the money that you contribute to these accounts are post-tax, meaning these contributions come out of your paycheck after you already paid your taxes on them. So you might be wondering now, why would anyone ever contribute money to these retirement accounts then? Well, the simple answer is that you don't have to pay taxes when you withdraw your money from these accounts at retirement age. And the beauty in that is that it includes any investment gains that you earn with your money in those accounts. So let's say, for example, you're retired and you take $5,000 out of your Roth IRA account. You don't have to pay any taxes on those. As you can see, both of these approaches offer some sort of tax benefits that you don't get with a regular savings account. For example, when it comes to a savings account, you're contributing post-tax money, meaning that you already pay taxes on that, as well as you're going to be paying taxes on any gains that you make in that savings account. However, both 401ks and IRAs have a lot of limitations when it comes to withdrawing your money, especially when you haven't reached retirement age. However, when you reach retirement age, then your withdrawal options are limitless. So now the big question is, should you make contributions towards your post-tax retirement accounts, or should you make contribution towards your pre-tax retirement accounts? And the simple answer to this question is no one really knows. And the reason for this is because there is one factor that remains unknown, and that is simply, what are the tax brackets going to look like in the future? For example, will tax brackets be higher? Will tax brackets be lower? Will it be lower for lower income people? Will it be higher for higher income people? The answer is no one really knows. The only idea we feel pretty confident about is that the lower your income at retirement, then the lower your tax rate will probably be. The United States has a progressive tax system, simply meaning that the lower your income, the lower rate of taxes that you have to pay. While in the future, the system could be more progressive or even less progressive. However, I think we're pretty confident that the higher income that you earn, the more taxes you'll pay relative to those who are lower income. Given that idea and logic, we can probably offer some general recommendations that would be helpful. The first one is the higher your income is, the more attractive the post-tax retirement accounts look. That's because the higher your salary is right now, the higher your tax rate is going to be. However, it's unlikely that at your retirement age, your tax rate is going to be the same. It'll most likely be lower than it is currently now. If your salary is on the lower end, then contributing to your Roth IRA or Roth 401k might be a better choice. That's because you're already in a lower tax rate or tax bracket right now, so you might as well take advantage of that. Sure, when you retire, you could find that your tax rate could be lower, but it can't be that much lower, but it could be much higher. However, if your salary is pretty strong right now and you don't anticipate any large jumps in the future, then contributing to your 401k, your 403b, or your traditional IRA account could be the best bet for you. That's because you're paying a high tax rate right now and you want to be able to reduce that taxable income amount by contributing to these accounts. Sure, when you retire, you could find out that your tax rate could be higher, although it probably isn't going to be much higher, but it certainly could be much lower. There is, however, one minor factor that would trump all of this, and that simply is employer contributions. So if your employer is chasing contributions, then ignore everything we just said and chase those contributions. As always, thank you so much for watching. If you have any questions about this topic, feel free to leave a comment down below and we'll get back to you as quickly as possible. And remember, if you enjoyed this video, make sure you smash that subscribe button and smash the like button to always get the latest and greatest from The Simple Dollar. And you can always find this content and loads more by visiting thesimpledollar.com.